Good evening, all the joinees. Thank you for tuning in. This is Prajakta. I welcome you all on behalf of NGEN Research. Meanwhile, others join. Let me introduce the topic for today's webinar. Today, we are going to touch upon risk parameters that are used for analysis of mutual funds. During our discussion for the topic related webinar, we will cover value at risk, which is a key parameter for measuring the downside risk of mutual funds. Next is the capture ratios, typically upside capture and downside capture both. Next, we will move forward and see how risk and return scatter plot is visible on NGEN Markets, which gives you a bird's eye view on both risk as well as the return that a fund generates with that level of risk. Now, this is always a relative comparison. We will see this on list of funds. And lastly, we will also check this on a portfolio level because we've made some slight changes on risk versus return scatter plot on portfolio analysis. Next, we will move forward and understand how you can check drawdowns and their respective recovery on NGEN Markets. This will be done on a list of funds in the compare section. So this helps us in determining what is the strength of each of these funds along with that of the benchmark to bounce back from a loss that it has experienced. Lastly, we will move forward and understand rolling returns analysis on list of funds, comparing that with a yardstick of a benchmark. We can do that in the compare section again, as well as on a single fund level. Finally, we'll throw the forum open for a Q&A session wherein you can unmute yourself to ask your questions or just type in your questions in the chat box. All right, so let us now begin. For the topic related discussion, we will, during the course of the webinar, keep on toggling between the compare section and single fund analytics. Right? So firstly, let's, for example, consider large cap as a category for the purpose of our analysis. To do that, you go to the funds section. In the funds section, you choose filter categories in the first tab, that's the screener tab. In filter categories, when you click on it, 4 buckets open up. In this case, because large cap is from the equity bucket, so you locate large cap funds here and tick that checkbox. When you hit on close, all the large cap funds will open up. Now, in this case, we have a list of 32 large cap funds into our list right now in the screener. However, let's say we do not want to screen or for that matter, view all of these parameters on this entire list of 32 funds. We want to first filter out some funds from this list on the basis of some basic filter parameters. So for that, you go here into apply filters section and let's apply some AUM and age filters. So let's say I want only those large cap funds who have at least an AUM of 5,000 CR or more. So I put 5,000 here and then I hit apply. When I do that, from a list of 32 funds previously, my list has gotten shortened to a list of 11 funds only, and that is visible clearly right here. Next, to top it up, let me kind of exclude young funds from this list, and therefore I'm just ensuring that I put minimum age as a parameter. Let's see if putting minimum age really makes any changes to this particular list. We are anyway left with 11 large cap funds now. So I put minimum age is 5 because I want to exclude any of the younger funds, if any. And then again, hit on apply. I can see that the list remains the same. So all of these funds, which are 5 years or older at least, have had a AUM of 5,000 or more, 5,000 crores or more. Now, once this is done, we have this preset column views, which you can use to view only risk related columns. That is because we are going to discuss on the risk parameters to analyze mutual funds. Therefore, I will click on this drop down and focus on risk columns as a parameter from here, this drop down. When I click on it, the column view gets changed, and now only limited columns are visible. Of course, basic columns will stay. So engine fund score, AUM of each of these funds, their split, or rather their holdings into top 3, top 5, top 10, and so on will definitely stay. Right? From here on, begin our risk parameters. And the first one that we are going to focus on to start with is the value at risk. So abbreviation of VAR is value at risk. Now, this practically means that if history were to repeat with a given confidence interval, in this case, because we are in the funds section, it is set at a default confidence interval of a 95%. That means if history were to repeat with a 95% confidence interval, I can say that iPro Blue Chip, in this case, that's the first fund that I have in this list, will have a downside risk of 26%. Now, this, please note, is since inception of this respective fund, because in the fund section, you do not put in any start date here. So this value at risk parameter that you can see of 26% is since the inception of iPro Blue Chip Fund, which is of course last 16 years into consideration. And this number is always annualized. Now, in order to understand this in a little better manner, in addition to comparing it with a yardstick of a benchmark, let me load iPro Blue Chip in a new tab, and let's see how the parameter could further be understood in a better manner. To do that, I simply click on iPro Blue Chip. It gets open in a new tab. And then you need to ensure, as I previously mentioned, in the funds section, it is always since inception. So when you load in iPro Blue Chip, there is a start date option. You click on change and you make it since inception. When you change the start date to inception, now you can see the analysis is being started from 23rd of May 2008. Right? And the value at risk as a parameter, as you scroll down in the fund performance tab, will be visible right here. That's historical VAR of 26.12%. And this exactly matches with what we were seeing in the fund section. This kind of validates that everything in the funds section is since inception of the respective funds. Nowhere do we consider any start date in the fund section. Right? Now let's understand this intuitively, what this would mean when it is measured against benchmark. In this case, because it's a large cap fund, the relevant benchmark, Nifty 100 has been chosen. Now this means that if I invest 100 rupees simultaneously in the benchmark, which is in this case Nifty 100, as well as the fund, my investment or my capital of 100 rupees would get eroded to an extent of 26 rupees. That means 26 rupees will go away if I invest in iPro Blue Chip. On the other hand, if I invest that same amount in the benchmark, that's Nifty 100, out of that 100 rupees capital that I have invested, 28 rupees would be wiped off. In other words, in the fund, 74 odd rupees will be my capital that will stay intact. And in case of benchmark, that the same amount will be around 72 rupees. Right? So as compared to that of the benchmark, this fund has a lower downside risk. Now, please note, this is the worst case scenario if history were to repeat with a 95% confidence interval. This is your downside risk of the fund. Right? Now, you will see on the platform there are two value at risk measures. One is historical, the second is implied. The interpretation remains the same even for implied value at risk. However, what changes is the underlying calculation that goes in, the baseline basically. So value at risk historical takes into consideration the annual historical return numbers to make these calculations. On the other hand, implied value at risk takes into consideration the volatility numbers of the fund, in this case, of course, the asset, as well as the benchmark. That's the only difference between the calculation of the two. Interpretation remains exactly the same. What is the value that I have invested in a particular fund that is at risk? At risk of what? At risk of losing. Now this, we have checked this on list of funds, that is peer group, in the funds section. We also saw this on a single fund basis to actually compare it with that of the benchmark. But here, if you see, everywhere until now, we've kept the start date as the respective fund's inception. Let's say you want to compare a fair, you want to make a fair comparison with the peer groups, right? In order to do that, you'll have to set in a start date, common start date, so that all the funds value at risk is getting calculated for that exact same time period. This will not be possible in the fund section because fund section, it always calculates since inception. Now, in order to do that, what you will need to do is you'll have to take all of these funds from the fund section to the compare section. In order to do that, you simply click on add top 50 to compare. In one single click, all of these funds will get added in this compare section, which is right next to the funds. The moment all of these funds are added in the compare section, the first thing that you will do is change the rates. To change the rates, you see this settings column over here, right beside return columns color coded into green. You click on that and put in a start date. Now let's say we want to check value at risk as a number for last 1 year. So you change the start date, you choose 2023, and let's say 10th of November. Then hit on go. When you do that, now all of these value at risk numbers have changed. In fact, you can practically sort this on ascending and descending manner, and you can check the fund which has the lowest or rather the highest downside risk is in this case Nippon India Large Cap Fund. On the other hand, the fund with the lowest value at risk for the last 1 year under consideration is UTI, followed by that is iPro. Now to this, if you want to add in a yardstick of a benchmark for the entire peer group category, so that you can check which of these funds have a higher value at risk when you compare that with the benchmark and which of them have lower. To do that, let's simply go here in the compare section at the top and choose in Nifty 100, which is the relevant benchmark. It gets added as a color coded into blue column, color coded into blue row, which differentiates it from the other funds that we have loaded. And then, of course, you can sort this ascending or descending manner. And we can see that the benchmark's value at risk for the last 1 year is 19.80%. As compared to that, only one single fund has a value at risk number that's over or rather higher than the benchmark itself, and that's Nippon. Now, by default, you will see there is no confidence interval mentioned here in the compare section. Therefore, by default, it will always consider with a confidence interval of 95%, right? Which even is visible in the fund section. We have clearly mentioned here there's a 95% value at risk that we are showing everywhere on the platform, unless and until you open it on a single fund level, wherein you will have the option to choose different confidence intervals. This being a statistical indicator, the most relevant or really significant confidence intervals that you could choose from will be 90, 95, or 99. So you could choose either of these three to get a number. Now moving on to the next parameter. Next in line are capture ratios. So until now, we've seen value at risk, which was independent of the benchmark, right? So you could calculate value at risk on a single fund, even if the benchmark was not loaded, right? But now to calculate capture ratios, you will have to load in a benchmark because these are relative parameters. So for that, using the scroller, You move on to the right hand side and you will see this. There are some pink color coded columns in the compare section. Currently, we'll see no data appearing here. That's because we have not checked box on the relative return columns. You check box this and a benchmark gets loaded. In this case, by default, Nifty 50 gets loaded. You'll have to change it to make it to the appropriate benchmark that you want to really load. So in this case, that's going to be Nifty 100. And again, you'll have to ensure the start date is exactly the same that you've input here for mutual funds. Only then it will be a fair apples to apples comparison. In this case, for all the mutual funds, we have put 1 year time period, that is 10th of November 2023 as the start date. Therefore, even for the benchmark, you'll have to choose a same start date. So again, 2023 and 10th of November. When you do that, you will see these last two columns in pink color codes are up capture and down capture ratios. Now, this tells you when the benchmark, which in this case is Nifty 100, was in a bullish trend, that is, it was going up, what was the upside capture that each of these funds had in this same time period, right? On the other hand, down capture ratio tells you when the benchmark was falling, when it was in a bearish trend, what was the resilience that was shown by each of these funds. Therefore, intuitively speaking, it totally makes sense that if a fund has a higher up capture ratio, the more desirable it is. Exactly converse is down capture ratio. So the lower down capture ratio it is, the better it is. Right? In order to understand this month on month split, we again go to single fund analysis. In this case, it's iPro Blue Chip. So we click on this and change the start date to a 1 year time period because that is what we were having a look at for up capture and the down capture ratios. When we change the start date, again, it's 10th of November 2023 now, and therefore it's now comparable. The up capture and the down capture ratios will be visible again here into relative returns column. Let's first understand up capture month on month split. You click on this I button. You will see only those months in the last 1 year have gotten captured here when the benchmark was in a bullish trend. That means you will not see a single month here in the upside capture ratio calculation when Nifty 100 was generating a negative return. Right? So, for example, you do not see October 2024 here. Why is that so? Because in the entire month of October, Nifty 100 in fact went down. Similarly, you cannot see a Jan 2024 here. That's because Nifty 100 would have gone down in that particular time period. Right? Now, when the benchmark was going up, for example, in this case, in the month of November 2023, the benchmark recorded an up move of 3.83%. At the same time, the fund, in this case, iPro Blue Chip, went up 4.36% in the same time period. All right, there's a question that someone has mentioned in the chat box that they're not able to hear my voice. Can you please confirm if my voice is visible? Anyone from my team?
It's audible, Prajakta. You can carry on.
All right. Thank you, sir. I would request you to please check audio connections at your end. It is pretty much visible, audible for other participants. All right. So we were talking about up capture ratio. As we had concluded, the 2 months that have not gotten captured were January and October. You will see that in the down capture ratio because that is the time period which indicates the benchmark's movement in a bearish trend. So in this case, you see October 2024, the benchmark Nifty 100 gave a negative 6.98% return. In this time period, the fund was pretty resilient and it fell only by a 5.53%. Right? Therefore, as I mentioned, lower the down capture ratio, the more desirable it is, and higher the up capture ratio, the more desirable it is. These were side and the downside capture ratios. Let's now move forward to some other risk parameters. Firstly, let's consider beta. Again, beta tells how sensitive is a particular fund, or for that matter, this list of funds, with respect to that of the benchmark's volatility. Beta of 1 is considered to be market beta, or for that matter, market risk. In this case, Nifty 100's beta with itself will always be 1. If we would have had a fund that has a beta that's above 1, we would have said that that particular fund is more risky than the benchmark itself. In this case, in the list that we are analyzing, there's no such fund which has in the last 1 year under consideration has reported in a beta of more than 1. Every single fund has a beta of less than 1. So this becomes one of the risk measuring parameters. Other than that, of course, the standard parameter is, of course, standard deviation, which is a measure of volatility in returns of each of these funds. Because that is not really dependent on any other benchmark, that's the reason it will appear in these green color coded columns. You kind of practically can sort this on the basis of ascending or descending order. And in this case, we see SBI Blue Chip, the last 1 year, has been a fund which is least volatile. It has a standard deviation of 11.93. On the other hand, if we consider only the peer group, that is only the funds, HDFC Top 100 happens to be the fund which has reported in highest volatility number, 14.11, which is just slightly lesser than that of the benchmark. Now, next, moving forward to the next subtopic in the webinar discussion, which is risk versus return. Now, given a level of risk, what is the return that a fund generates? To view that in a bird's eye view, we have this risk versus return scatter plot. When you click on this, there'll be a consolidated one graph view wherein you will see all of the funds that you've currently loaded in the main list get classified in 4 different quadrants. First being low risk, high return. Second is low risk, low return. Third is high risk, low return. And fourth is high risk, high return. Now, to do this classification on the x-axis, we consider standard deviation, which is a measure of risk, as we were just discussing. And on the y-axis, we have annualized return. Therefore, if a fund gets plotted on the right-hand side of this graph or of this scatter plot, then that is a fund which is riskier than a fund which is gotten plotted on the left-hand side. Intuitively speaking, so in this case, Axis Blue Chip, you see, is lying on the extreme left-hand side. Versus to that, we see a HDFC Top 100, that is a fund that lies on the extreme right-hand side. That means we can conclude that HDFC takes in higher level of risk as compared to that of Axis. Right? On the other hand, if a fund gets plotted at a height versus to a fund that gets plotted at a lower end, that practically means that is a fund that generates a better return than a fund that is getting plotted below it. Right? So in this case, Franklin is at a lesser height, which is around 12% return. On the other hand, iPro Blue Chip is at 14.5% return. Right? Now, this scatter plot also depends upon the time period that you choose. In this case, let's say if we want to do this again for 1 year time period that we were even doing in the main list, you simply go here in the start date parameter and make the changes as required. So let's say 2023, that's 10th of November, and then hit. In this case, as we were seeing, SBI Blue Chip lies on the extreme left-hand side. That is the fund that had lowest volatility, right? We saw that in the standard deviation calculation that we just did. On the other hand, HDFC Top 100 lies on the extreme right-hand side, right? Or for that matter, even Nippon is slightly even, similar to what HDFC is getting plotted at. However, you see the starking difference here. If an investor, for that matter, is ready to take same level of risk, right, as in case of HDFC, he might as well move from a HDFC to a Nippon, because with the same level of risk, we can see that Nippon is getting plotted at a height as compared to HDFC. That means with the same level of risk, Nippon is giving a better return than HDFC Top 100. Of course, this is considering last 1 year time period. So this is the risk versus return scatter plot. Let us now move forward to the next topic, which is drawdowns and recovery analysis. To do that, we move forward, or rather, we shift to this drawdowns tab in the compare section. The moment you come here, you will see there are 5 buckets. And each of the buckets will have size, length, and recovery as a parameter into it. Right. Again, there will be option to change the start date. In this case, now let's consider a 5-year time period to consider these drawdowns and recovery analysis. Right. So I'm going to consider 2019 November. And let me see the benchmark in this case. In this case, the benchmark is, of course, Nifty 100, and we have already added that. Let's see what was the drawdown that Nifty 100 experienced and how much time did it take to recover from its worst drawdown. To view that, you simply click on this history icon that appears beside the name of the index. You click on this, a small window opens up, and it tells you that the worst loss that was experienced by Nifty 100 as an index in the last 5 years was during the time period of onset of COVID, right? During January 2020 to March 2020, the index fell from 12,000 rupees or 12,000 level to a 7,000 level, 7,700 level, right? So that was a loss in magnitude of a 38%. Now to recover from this loss, that is to bounce back from a level of 7,700 back to a 12,400 level, the index took the next 165 working days to do so. Ultimately, on 9th of November 2020, the benchmark recovered its entire loss of 38% and it reclaimed the level of 12,470. In order to make this more relatable, let's focus on this drawdown, right? Since the end of September, there is a bloodbath that's going on in Indian markets. From 27,000 level, Nifty has crashed to 24,000 level. And that is exactly mentioned right here, right? So 27,000 was the level on September 2024. There's a 10% drawdown that happened and it reached a level of 24,000. And since then, because it's still hovering around that same level, this loss has not gotten completely recovered, and therefore we've mentioned this that the recovery is still ongoing. Whenever it reclaims the level of 27,000, the date will be mentioned accordingly. Now we've currently done this on this index, right? If you want to do it in comparison to a benchmark, which in this case is Nifty 100, let's sort this on the basis of recovery. And we see that from its worst drawdown to recover, these are the 3 funds that take lesser time than the benchmark itself. So these 3 funds recover in much shorter time period, typically Canara Robeco, right? It takes 144 days to bounce back from its worst drawdown when the benchmark takes 165 days. So this typically becomes helpful in gauging the strength of a fund to bounce back from a loss that it has experienced in past, or for that matter, typically if it's an ongoing loss, you can see the magnitude of it. This was the drawdowns and the recovery analysis. Let's now move forward to the last discussion, that is on rolling returns analysis, before we throw the forum open for a Q&A session. Rolling returns analysis is possible in the second tab in the compare section. You click on it and it gets open. Before actually diving into the numbers, let's understand some basic terminologies that appear here in the rolling returns tab. So the first thing is rolling window. That means the holding period under consideration when you're doing rolling returns analysis. Next is the start date and an end date. That is the time horizon under consideration. Again, to keep things simple, let's keep this at a 5-year time period. So now what we've done is the time period is 5 years. That is, if an investor would have stayed invested for any 1 year time period, that is 260-day time period. Now, why do I say 260 as 1 year? That's because everywhere on the platform, 260 is equivalent to 1 year in terms of working days. And we've clearly mentioned that when you hover on this particular question mark. That means if an investor would have invested for any 1 year time period in the last 5 years, then what would have been their returns from their investments in each of these funds? In this case, let's consider iPro Blue Chip, for example. In that case, he would have generated a 23% return from his investment for a time period of 1 year in any of the last 5 years. Again, comparing that with a benchmark, you see the benchmark rolling average return is at a 20.39, and the top 5 being Nippon, HDFC, iPro, Aditya Birla, and Kotak. Right now, if we were to understand the swing between high and low, that is the uncertainty between the returns of each of these funds, then the highest and the lowest rolling returns would be very helpful, because this tells you that fund, in this case, let's say iPro, can go as high as a 67%. On the other hand, it can stoop as low as a negative 1.65%. Now, this is given the time period of 1 year, any 1 year between the last 5 years under consideration. That makes the range or the uncertainty or the swing in the returns of iPro Blue Chip to an extent of 68%. How do we arrive at this 68%? So you simply consider modular difference, ignore the negative signs basically, between 67 and 1.65, and that's 68. Right? So the range, lower the range, the lower is the volatility typically in the fund's returns. And the last parameter is percentage positive. This tells you that if the returns of each of these funds are divided into just two quadrants, one being positive, that's above zero, and other being negative, that's below zero, then you can see that what is the probability of a fund generating returns in the positive quadrant, that is on the positive side. In this case, again, of course, this is with 1 year holding period. We can see that iPro Blue Chip has 99% of um, its returns in the positive quadrant, backtesting in the positive quadrant. On the other hand, let's check the lowest one of this lot. So that's Axis Blue Chip. If the holding period is 1 year, that's 260 days, in any of the last 5 years, 80% of its returns have backtested in the positive quadrant, that is above zero. Right? So this is what rolling returns analysis means, and could be used to check the consistency of each of these funds in generating returns. All right, now moving forward to the last part, which I mentioned, which was the addition that we have done in the risk versus return scatter plot. So as you saw in the risk versus return scatter plot in the compare section, only the funds get plotted, right? So this scatter plot is also available on a portfolio level. But on a portfolio level, we've now introduced two changes to this. So for example, I'm just going to load in a random portfolio. And you see this risk versus return scatter plot will now have a plotting of um, two additional components. One, of course, is overall portfolio volatility and return. And the blue color coded icon is for the benchmark. Previously, this was not there. We received feedback from a lot of our users, and we've kind of incorporated this new update now. You'll now be able to see two additional plottings, red color, a briefcase-like icon for the portfolio level risk and return, and the blue color coded icon for the benchmarks risk and return. So that's about it from my side with respect to topic related discussion. The forum is now open for a Q&A. Thank you. In case of any questions, please let us know and we'll try to address them. All right, there are two questions in the chat box. Firstly, we've missed initial 20 minutes of the session. Sure. So, the recording of the session will get uploaded on our YouTube channel by the end of next week. So you can definitely refer to the recording. Additionally, we have webinars every Friday. So you can definitely tune in next Friday. This week, Friday being a market holiday, we conducted this on a Thursday. Okay, so which place? Yeah, sure. So if you kind of check your NGEN Markets login, there'll be a YouTube icon at the top. You click on it. There's a playlist that is dedicatedly created for all of our past webinar recordings. You go to the playlist and there's this webinars as a separate list that's created. 136 videos already uploaded. This week's webinar will also be uploaded by mid or end of next week. You can definitely go through that. The second question, when we have an individual hybrid fund, let's say HDFC Balanced Advantage, the default benchmark is Nifty 50, but when I search for its actual benchmark, that's not available. So typically we have a list of 200 plus benchmarks to choose from. What happens is a lot of balanced advantage, or for that matter, hybrid funds, consider CRISIL as their benchmarks. Unfortunately, CRISIL refuses to share their data with us. They consider us as competitors and they are not allowing us to use their data. Therefore, CRISIL benchmarks will not be available, unfortunately. However, there are some hybrid benchmarks that you could, in fact, customize, right? So you simply go to a single fund. You were saying HDFC Balanced Advantage, right? So one second, let me kind of load that. You load this fund in a new tab, it gets open and you can practically search for it. In fact, build it, right? So this is 50-50, right? So you go to custom benchmark, you say manage custom indices. Let's say 50% equity, you want to give it an allocation of let's say Nifty 50. You say add index, you give it an allocation of 50. And for the debt equivalent of it, let's say you want to choose in a T-bill or a bond index, you add that, give it an allocation, let's say 50%, and name this benchmark. So let's say this is aggressive hybrid benchmark 1, and then click on save. When you do that, a custom benchmark will get created, and you can then start benchmarking the portfolio, or for that matter, this fund against that custom benchmark. All right, welcome. All right, so SIP returns, right? So SIP return, there's a separate tab in the compare section itself. You head over to the compare section. There's a separate dedicated place for SIP returns. Um, this is a comparison of list of funds along with its benchmark. So you can see for a time period that you can specify, right? We've not by default specified 1 year, 2 year, 3 year. You can choose in a time period. Let's say you want to check it for the last 1 year time period with an installment of, let's say, 5,000, which is of course editable, right? You put in a date here. So that's 1 year and then you hit run. So this is the XIRR of each of these large cap funds for the last 1 year. If you want to kind of check this in a single fund manner, in a detailed manner, You simply click on this piggy bank icon, it will load up in a new tab. And this is how you can check month on month as the installments went on, or rather kept on coming in, what change did it have on the portfolio value. So this is available to view as well. Okay, so there's a question which says, can you explain rolling returns again? So sure. So you go to rolling returns tab. Rolling window is typically the holding period. In this case, we already saw for 260 days time period, which is 1 year. Let's now kind of see this for, let's say, 2 year time period. So for checking 2 years, you simply multiply 260 by 2. That's 520. And you put 520 here and you hit run. In this case, you see now each of these funds, um, of course, barring one, which is Axis Blue Chip, all of them have um, or rather, become 100% positive. That means each of these funds, each of these large cap funds, if the holding period is 2 years, in any of the last 5 years under consideration, 100% of the times their returns were in the positive quadrant, that is above zero. Barring just one, that's Axis Blue Chip, when there was one single data point when the lowest was negative 1.74. Therefore, you see percentage positive is getting affected and it's not 100% positive. On the other hand, if you want to understand these highs and the lows in a detailed manner, let's say on a single fund basis, you can definitely do that. In this case, we've, I think, already opened iPro Blue Chip. You open this in a new tab, you go to rolling returns and you set in a time period, let's say 5 years. And let's kind of focus on 260 days only, right? That's 1 year. You turn off the black and the green line, which is 520 and 780. And you see the high that is coming in here, high of 67%. That is nothing but this peak that you can see. If you kind of zoom in here, you will locate that point also. When I hover on this peak, I see this high of 67.08% was reached by iPro Blue Chip on 22nd of March 2021. That means if an investor would have invested exactly 260 days prior to 22nd of March 2021, then his return from his investment into iPro Blue Chip would have been 67%. Right? On the other hand, of course, that happens to be the highest return with a 1 year holding period in the last 5 years. That's 2019 to 2024 with 1 year as the holding period because we are seeing 260-day time period. On the other hand, let's kind of try to locate the lowest, um, trough. So that's 1.65. It would be somewhere here. Yeah, right there. When I hover on this lowest point, I see the date that gets highlighted here is 13th of October 2022, when the return from ICICI was negative 1.65. That means if an investor would have stayed invested, or rather would have invested exactly 260 days prior to 13th of October 2022, that is somewhere around 2021, then his return from his investment into ICICI would have been a negative 1.65%. Right? So it can be as high as 67%, it can stoop as low as negative 1.65, given the holding period of 260 days. Now, as is said in mutual fund investments, as your holding period increases, let's say for in this case from a 1 year, that is 260 days, to a 2 year period, that's 520 days, you see even the lowest return becomes positive because of the absolute basis, you can practically change it to annualized basis. And you can see with a 2 year holding period, that's 520-day holding period, even the lowest return is positive 7.47. That could become a good talking point for you as a mutual fund distributor or an RIA to convince the client to stay invested in a particular portfolio, for that matter, a fund, instead of going into panic selling mode. Yeah. So this could be used. Any more questions? Please let us know. All right, it seems there are no more questions. In that case, we'll be wrapping up with this session. So thank you again, everyone, for joining in. Do stay tuned next week for a new topic. And you can definitely, as I mentioned, refer back to our previous week's webinar topics on our YouTube channel, the link for which is right there into the NGEN Markets login. You simply go on the YouTube channel, you'll be taken to our NGEN Markets YouTube page. There's a dedicated separate playlist for webinars. All right, thank you again for joining in. Have a great weekend ahead. Thank you.